Fundstrat Head of Research and Fundstrat Capital CIO Tom Lee, also a CNBC contributor, joins me here. Tom, good to see you.
Great to see you.
So we have this rally that's now extending probably beyond what most were positioned for, but it started in a moment of peak uncertainty.
Yes.
And even when we were in peak uncertainty, a lot of us were saying that's kind of usually forward-looking bullish. But are we now getting to a point where we have finally feasted on all of the uncertainty and now we have a lot of these blanks being filled in?
I don't. I think that it is appropriate that we are making new highs because the fundamental and the visibility is better now than it was in February at the old highs. And I think there's three levers that are going to get pulled. One we know is that the Fed didn't unleash liquidity at the April lows. So we have a Fed that's been on hold and tight. But if the information and the data comes in dovish, that's 12 to 24 months of Fed liquidity and dovishness. That hasn't happened yet. The second is that I think that there is a false argument. People are saying the multiples are stretched. The PE should be expanding because we've now had 5 stress tests that companies survived. They survived COVID, they survived the bullwhip effect, they survived the inflation surge, they survived the Fed fastest hikes, and now they survived Armageddon. If you don't have 5 more episodes, multiples will be higher 2 years from now. And the third is that I agree with anybody who says that, look, we've kind of reshaped some of the economic flows around tariffs, but that's an upside story because if it plays out better, that's an earnings surprise. So you have 3 levers that tell us that 6,200 is the market beginning to recognize we're in a better position while $7 trillion cash is on the sidelines. And I can tell you, our clients, institutional clients, remain very skeptical. This is the most hated V-shaped rally.
I grant that given the strength of the rally, investor sentiment pretty much across the board has lagged. It's not as bullish as you would normally expect. The $7 trillion in money market funds, though, I mean, to me, it's a non sequitur. It always goes up. Unless you're at the end of an awful bear market, the money doesn't come out of money market funds. And then right now, as a percentage of total market cap, the S&P is like $60 trillion, or the U.S. market is. But it's like, what are we talking about?
Well, there's a couple things to keep in mind. One, in fact, money market balances have declined. They only started to rise really in 2022.
And they went up.
If you look at margin debt, NYSE margin debt, the dollar amount absolute is still below where it was in October 2021. So you have like 4 years, it's 4 years and you're still not even higher in margin debt. And third, it really doesn't take, you don't need 60 trillion to come into the stock market to have it rise 10%. You probably need 200 billion. And I think there's a lot of high net worth money. I know there's a lot of our institutional long short macro that is shorting this rally. And the long only managers are defensively positioned. They don't believe in a cyclical long. But look, if rates come down and the Fed starts easing, it's going to force people into a cyclical tilt.
In terms of the jobs number today and how it bears on all of those factors, whether it's timing of the Fed, whether it's, the underlying resilience of the private sector, which maybe is still kind of in watch and see mode, how does that bear out?
Well, today would have been a day where if it was weak, then the Fed has to change its calculus. But the job market's good. So now the waiting game is, how much will inflation surge over the summer? Inflation expectations are actually coming down. So now all that we're waiting for is let it get through this CPI hump. I do think it means that once you get into September, we should really think about cuts coming. And that's what I would focus on more as an investor, that, well, that's a cutting cycle. The Fed won't just do one cut. They're going to continue cutting. ECB and the U.S., 200 basis point different in monetary policy rates. But if you take CPI year over year, ex housing, which is how Europe calculates it, we're both at 1.9% today.
돈 벌리게 불어날았네